Hello, and welcome to another episode of Trust Issues. Today, I'm sitting down with Steve Marshall, Chairman of Cordiant Digital Infrastructure Management, to talk about the fund and the opportunities for investors in the digital infrastructure equity sector. Steve, thanks for joining us today.
Hello, Joe. Thanks very much for inviting me. I really look forward to the discussion.
Fantastic. Can you start off by explaining what digital infrastructure is and also the areas you target in the portfolio?
Yes, of course. Well, digital infrastructure is defined differently by different people, but certainly for us and our listed vehicle, we define it as mobile towers for the mobile operators, fiber optic networks, or data centers. And we've invested throughout the last 3.5 years across those three sectors. We've now invested in the biggest tower business in the Czech Republic. We've invested in the big tower business in Poland. And we own the number two fiber optic network in Ireland and a small interconnect data facility at 60 Hudson in Manhattan.
And what's your objective for the fund? Are you looking for capital growth, income, or a combination of both?
Combination of both, growth and yield. That's what we set out in the tin when we listed the vehicle 3.5 years ago on the London stock market. So what do we mean by that? We want to buy good quality assets that have the opportunity to drive further investment. So that's building the asset base, but also that are generating cash from day one and will continue to drive growing cash flows so we can actually pay a yield to our investors. So yield and grow, very much so.
And what are the key attributes that you look for in a potential investment?
Well, obviously, it's got to pass the filters, so it has to be digital infrastructure, right? So it's either the towers, it's fiber, or it's data centers. We've said that we will invest in OECD countries, so that's sort of UK, Europe, North America. And then I'm really looking for the value, right? I'm looking for businesses that are generating good cash flows today with management teams and a market position, a competitive moat, which will allow them to continue to grow those cash flows well into the future. I'm very reluctant to invest in assets that are not generating cash today and that have very, very long lead times to becoming EBITDA positive. And we've seen a number of those with the altnet sort of fiber investments in the UK, which I've looked at quite a number of those over the last 2 to 3 years, but they're not for us. Every time we've invested, with the one exception of our data center in New York, which is a small part of the portfolio, we've invested in very strongly cash flow generating assets with future growth opportunities.
And how is a portfolio structured? Do you hold these assets directly or do you invest alongside others?
We primarily own 100% of the investments that we make. There has been one exception to that, our most recent acquisition of two data centers in Belgium. We've done in joint venture with Tink, which is a similar sort of company to ourselves, a European style sort of investment trust. And we're acquiring those two data centers in joint venture with them. But all of our other assets are 100% owned. I come from the corporate world. I'm chairman of all of our other assets. The CEOs report to me. And I think that way I'm able to work with them in order to help them to grow the asset base strategically and operationally.
And how does this approach help with risk management?
Well, I think when you own a business, it's certainly a lot easier to be able to pursue your own strategic objectives. I think some of our investors would like us to be more diversified across the portfolio, but we're somewhat restricted in terms of the amount of capital we have available to us in order to do that. So we have invested now in effectively 6 different legal entities across geographies. But within those legal entities, there is a vast array of diversified infrastructure. We've got over 10,000 kilometers of fiber. We've got over 1,000 towers, which are broadcast towers and mobile towers. We've got hundreds of thousands of IoT sensors that enable smart city activities. We have microwave dishes that support backhaul for our customers. So there's a whole array. We've got data centers across the Czech Republic. We've got another data center, as I mentioned already, in New York. So there is a wide array of underlying assets within these legal entities. And frankly, we could sell down our mobile tower portfolio in the Czech Republic. We could sell it mobile tower portfolio down in Poland. We could sell down our data center business, but we don't have to, right? And whilst we see continued growth in these businesses, I certainly wouldn't advocate it, right? These businesses are doing exceptionally well. They're growing. I don't know whether, Joe, you've seen our half-year results, but we've shown exceptional levels of growth for the first half year, 9% growth in revenues, 15% growth in EBITDA. So whilst this collection of assets is showing these really great growth financial metrics, we'd like to keep onto them and keep driving the returns for our investors.
As you mentioned earlier, you invest in the likes of digital radio and broadcast television in the portfolio. In some ways, these could be viewed as old technologies with the advent of streaming. So, could you explain the investment case for these?
Yeah, I think that is a much misunderstood concept, that these are sort of traditional or old or redundant technologies. I mean, proof of the pudding's in the eating, right? Just look at the revenue growth and look at the EBITDA growth that's coming from this collection of assets. So what we are seeing, and I think we will continue to see in Poland, the Czech Republic, there is increasing demand for access to the terrestrial broadcast infrastructure. We've just let two new channels to broadcasters in Poland under an auction process run by the government, where there were more interested broadcasters to get access to our platforms than we had availability. So as a result of that, Emitel, our Polish company, has applied to the government for additional spectrum and to license another MUX to be able to make more channels available to more broadcasters or existing broadcasters. So there's clearly a demand. Why is that? Well, delivering the signal over the broadcast system is the most cost effective way of getting large quantities of video content to the mass population. And it is the most environmental way of delivering mass video content to the population. So over time, people will realize, governments, regulators, the wider industry will realize the benefit of continuing to have broadcast delivery integrated into the terrestrial system. And frankly, we are now testing what's a standard called 5G broadcasting, which would actually expand access to this content across a much broader range of devices. So it's probably going to be 2 to 3 years before we bring it to market. But when we bring it to market, anybody with a 5G phone or a 5G chip in a laptop or a 5G chip in a television screen would actually be able to receive broadcast through that 5G chip. And it wouldn't have to be part of your data agreement with your mobile operator. It could be, free use to the handset, free use to the laptop over the 5G chip. At the moment, if you want to access video content, it gets taken off your data plan. But with 5G broadcasting, it doesn't have to be taken off your data plan. It could be free at the point of use. So, I could well see that, in 5 or 6 years' time, one of the mobile operators will launch the next iteration, and the big unique selling point will be that you can receive all terrestrial TV on there free of charge without it impacting your data plan.
So many thanks for explaining that. The trust has been going since 2021, although the team has been operating in this space for much longer. Could you provide an overview of the trust performance since inception?
Trust performance, certainly operationally, has done exceptionally well. We said at the time of listing the trust on the London stock market that we would aim to deliver a 9% total return to our shareholders. That would be a mix of capital growth and a dividend. We're now delivering over a 5% dividend, and we've grown overall since inception 11% internal rate of return from this asset base, despite the drag that comes from only investing capital over time as we find the right sort of opportunities. So 11% internal rate of return since inception, which beats that 9% hurdle rate. Having said that, that's operationally. That's with cash flows coming from the operating businesses. It's with the revaluation by external valuers to generate, what is the net asset valuation for these businesses collectively. So that has shown the 11%. But if you were to buy into the shares today on the London stock market, the shares are actually trading at a discount to that net asset value, and actually a fairly sizable discount to what external valuers would value a portfolio at. And probably around about 28-29% discount to net asset value. So from that perspective, it's been somewhat disappointing that the share price has not kept up with the external valuation of these assets. But we have shown some progress over the last few months, starting to reduce that discount from around about 40% to, as I say, probably about 28% today. And I think the sector as a whole has been struggling with various macroeconomic issues that have been detrimental to the value of all sorts of investment trusts within the sector. Even some of the long established Rolls-Royce investment trusts are still showing a discount to net asset value at the moment. So we've been a little bit of a shining light in a dark sea of underperforming investment trusts compared with the NAV. And not necessarily because any of these businesses are not good, it's because of these wider macroeconomic issues that hopefully, will abate over time. Obviously one issue was the rapid increase in interest rates. And when interest rates went from sort of 1.5% to 5.5%, naturally people take the money out of the market, they put it into deposit accounts, they put it into the building society, maybe they even buy gilts that are paying 5.5%. And if they take it out of the market, if they take it out of what were, diversified high yield assets like investment trusts, then there's less demand for those stocks and therefore prices come down. Now, if interest rates start to pull back over the next year or two, you'd expect new inflows coming into the investment trust market, and maybe reducing that discount to NAV. So hopefully that's the case. But operationally, our businesses have done exceptionally well. I can't be more pleased in terms of the growth in the revenues, the growth in the EBITDA, but somewhat disappointed that that's not reflected in a fully valued share price today.
You've recently refinanced the debt facilities for the trust. Could you talk us through the current gearing level at both the trust and company level, and also how this recent refinancing has helped lower risks?
Yeah, I'm naturally conservative. I'd like to pursue, conservative policies with the trust. So we've tried to keep a fairly conservative gearing level across the portfolio of just over 4 times EBITDA. Now, in some industries, people would say that's not particularly conservative, but because of the nature of our portfolio, which is long-term contracts, blue chip clients with escalation clauses, bankers are willing to invest quite high levels of gearing, right, for this type of asset base. So 4 times for this type of asset base is seen to be quite conservative. My old company, American Tower, is 5.5 times debt to EBITDA. Cellnex in Europe, a big mobile tower business and broadcast infrastructure business, has got probably 6.5 times net debt to EBITDA. So 4 is quite conservative. But in addition to that, we've renegotiated debt facilities both at the opco level and at the holdco level over the last couple of years. We've extended the terms. We've baked in the interest rates at a high degree of fixed price interest rates with interest rate swaps. And now we don't have any debt coming due until July 2029. So we've got no refinancing risk, right, for quite a number of years as we go through turbulent or uncertain times.
Absolutely. And one final question for you. Some of the newer investments in the portfolio have been focused around data centers. Do you see this as one of the key growth areas for the trust?
Yeah, data centers are undoubtedly highest growth investment to date. You can't pick up a paper these days without reading the additional demand for data center capacity, that being driven even further with the notion of AI and how much computing power that needs and how many servers you're going to need and wider data center capacity. So that's the macro background. The data center market can be segmented, in many ways. And we are really invested primarily in edge facilities or with our US facility, an interconnect data center. But primary investment is in edge facilities in the Czech Republic. Now, what does that mean? It means that we have 8 small data centers close to the population centers, which gives easy access to corporate customers, to users of those facilities. And frankly, they've been selling out like hotcakes. And every year they've been building another edge data facility. They've just built their 8th edge data facility. They think that will be sold out probably by the middle of next year. So they're now already starting to work on expanding the Zisco facility again in downtown Prague to expand that. And if they get the appropriate building approvals from the local municipality, that should be coming on stream probably in Q3 of next year. So again, incrementally adding more capacity. So they have built a fantastic reputation. This is CRA in the Czech Republic in building these facilities, in servicing corporates and governments and internet service providers. And now we are looking to repurpose a huge piece of land in the suburbs of Prague, which used to house 3 1,000-foot AM radio towers. And we've decommissioned those. We're moving people from AM radio to FM and to DAB radio, which is much more energy efficient and better quality signal. So we've decommissioned those AM radio towers. There's fibre going into that site. There's a substation on the site. We've got contracted revenues. So we've gone to the government and said, can we repurpose this brownfield site to build, a state-of-the-art data center? And it's taken 2 years to get zoning approval for it on a brownfield site, but the government last week actually gave us, go ahead to develop that site for a 26 megawatt data center facility, which is absolutely awesome. If we do that, we've got a little more work to do in terms of doing the final designs, getting the prices from contractors, and then also having discussions with potential anchor tenants. But I would expect that to go pretty well over the next 6 months, and we could be breaking ground probably in the middle of next year if all goes well. But if we do that, I mean, CRA will be the biggest data center provider in the Czech Republic. And that will be a fantastic credit to the very strong management team that we have in CRA. So very much looking forward to that and building the data center franchise on that basis.
And that's a very positive note on which to finish. Steve, many thanks for joining us today.
Thanks very much, Joe. It's a privilege to get access to your readership, and I hope that's helped them to better understand the nature, the breadth and depth of Cordiant digital infrastructure listed on the London stock market. I hope it gives them better insight into the business and its future potential. And we'd love to have you if you want to invest in the business and be part of the success story and part of our growth. So thanks very much for inviting us today, Joe. It's been a pleasure talking to you.
Thank you. I'd encourage you to visit Cordiant's website to find out more information about the Trust, including recent articles and videos. And you can also head over to the Kepler Trust Intelligence website to find our latest research note and insight articles. Thanks for listening, and we hope you join us again soon for another episode of Trust Issues.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.